So if you want to find the actual real winners of the artificial intelligence revolution, you might want to stop looking at all the flashy software algorithms coming out of Silicon Valley.
Yeah, you really have to start looking at the plumbing.
Exactly, because beneath this massive, multi-trillion-dollar digital expansion we're living through, there's a very physical reality.
Right. Servers run hot.
They run incredibly hot. Microchips require insanely pure water. Rockets need perfectly filtered fuel.
And the companies building the physical arteries and veins of this new digital infrastructure are posting numbers that would make a hyper-growth tech startup incredibly jealous.
Which is exactly why we are tearing into the Q2 2026 data of IDEX Corporation today. Ticker symbol is IEX.
A century-old manufacturer of pumps, valves, and highly engineered industrial components.
Right, and our mission for you today, as always on this deep dive, is to cut right through the dense corporate speak. We want to pull apart the actual engineering and the financial mechanics of what IDEX is doing.
Because we need to figure out if this boring industrial stalwart is quietly becoming the most critical supply chain bottleneck for the next decade of tech.
Okay, so let's unpack this, because the narrative on Wall Street has always been that a company like this is just a GDP plus business.
Yeah, the old, if the economy grows a little, they grow a little mindset.
Exactly. But then they drop this recent quarter, and suddenly we have this fascinating, completely counterintuitive dichotomy on our hands.
You really have to dig past the first line of the press release to understand the paradigm shift happening here.
If you look at the surface level data, you might actually miss the explosion happening underneath.
Totally. So if we look strictly at the headline revenue, you see organic sales grew by 5%.
Which, in the industrial sector right now is fine.
Right, especially in a macro environment burdened by stubborn inflation and, cautious capital expenditure from traditional distributors. A 5% top-line expansion is solid. It demonstrates resilience.
But it's not exactly setting the world on fire.
No, it's not. But revenue, by its very nature, is a backward-looking metric. It only tells you what IDEX successfully manufactured, shipped, and billed over the previous 90 days.
Right, it's in the rearview mirror.
Exactly. The metric that fundamentally alters the thesis for this stock, and the one that demands our attention today, is the order book.
Oh man, the order book.
Total orders for the company surged 28% organically year over year.
And that is the massive divergence we have to start with. 28% organic order growth for a heavy manufacturing company?
It's almost unheard of in this space.
We are not talking about a software as a service business here. We're turning on, 28% more user licenses, costs practically nothing, and happens instantly.
Right, you just flip a switch in the cloud.
Exactly. We're talking about highly engineered physical hardware, custom machine fluidics, high purity gas filters, precision pneumatic systems.
Stuff that requires real raw materials and factory time.
Right. So for an order book of that physical complexity to expand nearly 30% in a single quarter, it implies a tidal wave of forward demand.
It's a massive disconnect between the 5% they are shipping right now and what their end market customers are desperately screaming at them to manufacture for the future.
It really is. So what does that tell us about their operations?
Well, it indicates a structural shift in their end markets, which we will definitely dissect shortly. But what makes that 28% order surge so compelling financially is how ruthlessly efficient IDEX has become.
You mean at converting that volume into actual operating profit?
Exactly. Their adjusted EBITDA margin expanded 70 basis points year over year.
Landing at 28.1%, right?
Yes. For a company dealing with raw materials, global supply chains, physical factories, and heavy freight, keeping 28 cents of operating profit for every dollar that comes through the door is it's a testament to extraordinary operational leverage.
That is a wildly profitable factory floor.
It really is. As that massive backlog of orders eventually flows through the income statement as revenue over the coming quarters, that margin profile suggests we are going to see a phenomenal cascade of bottom line cash.
Which brings us to the actual bottom line for Q2. The adjusted EPS came in at $2.32.
Completely obliterating their own guided range of $2.07 to $2.12.
Yeah, that represents a 12% growth year over year.
Mm-hmm.
And on top of that, they put in $177 million in free cash flow in just 90 days.
It looks like a flawless fortress of a quarter.
It does. But, and this is a rather large but, as you know, anyone who has spent time modeling financial statements knows you can never just take the headline EPS at face value.
Oh, never. You always have to read the footnotes.
Always. And Management spent a significant amount of time on this earnings call walking analysts through a very specific kind of messy accounting maze regarding the IEPA tariff refund.
Yeah, that is the critical asterisk on this quarter. The historical IEPA tariff framework is one of those complex, retroactive governmental mechanisms that can completely distort a company's financial reality.
If you don't adjust for it, at least.
Right. So in this quarter, the U.S. government finalized a review of these historical tariffs and issued substantial refunds to IDEX for tariff they had previously paid on imported components.
And when a multinational corporation receives a massive retroactive tariff refund, it doesn't just show up as a single line item of unexpected cash, does it?
No, it cascades through the financial statements in 3 distinct, highly specific ways.
Okay, let's break those down. The first impact hits their gross margins, doesn't it? Because those original tariffs were baked into the cost of building their pumps and valves over the past few years.
Precisely the right way to look at it. Because the original tariffs were recorded as a cost of sales, the sudden refund of those tariffs acts as a one-time massive reduction to their current quarter cost of sales.
So it artificially suppresses the cost of making goods in Q2.
Yes, which mathematically inflates their gross margin and their EBITDA margin for the period. It makes the core manufacturing process look much more profitable in the specific 90-day window than it actually is structurally.
It's like buying a car 3 years ago, and suddenly the dealership sends you a rebate check in the mail today.
That's a great way to put it.
If you look at your personal budget for this month, your expenses look incredibly low, maybe even negative. But it would be a huge mistake to assume your monthly living expenses have permanently decased.
Exactly. It is a one-off injection. But that was only the first part of the accounting cascade. The government didn't just give them the principal back.
Wait, really? There was more?
Yeah, the federal government held those funds for an extended period during the review process, which means they were required to pay IDEX interest on the principal.
Oh, of course.
So the second impact is an injection of interest income. This hits below the operating line. It reduces their net interest expense for the quarter, providing yet another artificial bump to the final earnings per share.
Okay, so we have a massive one-time reduction in cost of sales, padding the margins, and a one-time injection of interest income padding the EPS. At this point, it sounds like a pure windfall.
It does, but there was a structural catch to this refund that actually hurt their top-line numbers.
Right, because IDEX doesn't operate in a vacuum.
This is where the mechanics of industrial supply contracts become fascinating. In many of their long-term supply agreements with major customers, they have risk-sharing clauses regarding government tariffs.
Basically saying, we share the pain and the gain.
Essentially, yes. IDEX and the customer agree to share both the pain of unexpected tariffs and the gain of any subsequent refunds. So when the U.S. Treasury wired IDEX this massive IEPA refund, IDEX was legally obligated to turn around and issue customer rebates for a portion of it.
And under standard accounting principles, issuing a rebate to a customer isn't recorded as an expense, is it?
No, it is recorded as a reduction to top-line sales in the current period.
Ah, okay. That completely explains the massive discrepancy in the organic growth numbers. The headline press release said organic sales grew 5%. But management noted that issuing these mandatory rebates back to their customers acted as a 200 basis point drag on the top line.
Right. Meaning, if we pretend this entire government tariff situation never happened, the actual organic revenue growth of the underlying business would have been 7%.
Which is a remarkably strong print for an industrial manufacturer right now.
Very strong. But when you synthesize all 3 of those accounting impacts, the artificial boost to margins, the below-the-line boost from interest, and the top-line penalty from rebates, it resulted in a net mathematical benefit of 8 cents to their adjusted EPS for Q2.
Okay, let me push back on this massive beat for a second then. Management guided for an EPS of $2.12 at the high end. They reported $2.32. That is a 20-cent beat.
Correct.
But you're telling me 8 cents of that was just a bureaucratic government check clearing the bank. Is this entire EPS beat just an accounting illusion?
It's a fair question to ask.
Because it feels a bit like putting on an old winter coat you haven't worn since last year, reaching into the pocket and finding a crisp $20 bill. It's an awesome feeling. It absolutely makes your day, but you cannot walk into the kitchen, show it to your spouse and say, honey, my core earning power has increased. I got a raise at work.
That analogy perfectly isolates the tension in this earnings report.
Right. It's a fantastic one-off event, but it has zero bearing on your future cash flows.
Exactly. As an investor, you have to decipher whether you are cheering for sustainable operational excellence or if you are just cheering for the winter coat $20 bill.
And if it were just the coat money, the investment thesis would be incredibly weak.
It would be. However, the data aggressively supports the former. If we perform the exercise of completely stripping out that 8-cent tariff benefit, effectively acting as if the government never wrote the check, IDEX's adjusted EPS would have landed at $2.24.
Which is still 12 cents above the absolute top end of their own guidance range.
Exactly. They still crushed expectations even without the government windfall.
Okay, that makes me feel much better about the numbers.
And the underlying strength extends to the margin profile as well. The tariff refund distorted their reported EBITDA margin upward by a massive 130 basis points. It made the profitability look superhuman.
But even when you back out that 1.3% artificial bump, they still did great, right?
Yeah, their underlying normalized business still executed near the very high end of their margin guidance framework. The CFO, Sean, was incredibly transparent about this on the call.
He really wanted to make sure the analyst community understood that the underlying business volume, the pricing power, and the operational execution were the true drivers here.
He absolutely did.
So backing out that 8-cent government check, the fundamental business is still surging. The margins are holding up beautifully, and we are still staring at that staggering 28% surge in underlying orders.
That order book is the real story.
It is. But what exactly are they selling that's driving that kind of forward demand in a relatively stagnant macroeconomic environment? Because it sure isn't standard agricultural pumps or basic municipal water valves driving this.
No, definitely not. To figure that out, we have to look at the segment breakdown. And one specific division is absolutely carrying the team on its back right now.
You're looking squarely at the Health and Science Technology segment, or HST. The divergence in performance here compared to traditional industrial benchmarks is almost difficult to comprehend.
The numbers here are just staggering. In a quarter where total company orders grew 28%, the HST segment saw organic orders grow by an astonishing 47% year over year.
And revenue in the segment grew 12%. I want to pause on that because 47% order growth in physical manufacturing is the kind of metric that breaks financial models.
It really is. It usually implies either a massive, unrepeatable one-time contract or a fundamental change in the structural demand for a product.
And so which one is it here?
It is unequivocally the latter. To understand the mechanics of this acceleration, we have to translate IDEX's corporate strategy into real-world physics.
Okay, let's do that. Because if you analyze the broader macro-industrial economy right now, things are pretty sluggish.
Very sluggish. PMI data is mixed. Industrial distributors are aggressively managing their inventory down because carrying costs are so high with current interest rates, and inflation has made everyone cautious.
But IDEX's explosive growth in the HST segment completely bypasses that sluggishness.
Because it is hyper-concentrated in what management calls advantage markets.
Advantage markets, yeah, that was definitely the buzzword of the earnings call. But let's de-jargon that for you, the listener. We aren't talking about broad, slow-moving GDP sectors.
No, looking at the transcript, the growth is aggressively concentrated in 3 highly specific areas: data centers, semiconductors, and space and defense.
And what is crazy to me is that these 3 hyper-growth applications have expanded so rapidly that they now make up over 1/3 of all HST revenue.
And the centralization of that revenue is entirely by design. Let's examine the first advantage market, data centers and artificial intelligence, because this is where the gap between software hype and physical reality is the widest.
The market is obsessed with the neural networks, the large language models, and the theoretical capabilities of AI. But artificial intelligence, at its core, requires a massive, unprecedented amount of physical computational power.
Right. We are talking about hundreds of thousands of next-generation GPUs packed into warehouse-sized server farms.
And when I think of that AI boom, my mind naturally goes to NVIDIA designing the chips, TSMC manufacturing them, or Microsoft building the data centers. I do not immediately think of an industrial pump manufacturer in Illinois.
Most people don't.
So how on earth is IDEX monetizing artificial intelligence?
It comes down to the brutal thermodynamics of high-density computing. These next-generation AI chips process data at such an incredible velocity that they generate a dangerous amount of heat.
Like literally melting themselves if left unchecked.
Exactly. Furthermore, the sheer scale of the electricity required to power these server racks is straining local power grids. IDEX's Performance Pneumatics Group is winning massive contracts because they engineer the mission-critical systems that prevent these data centers from failing.
So at the macro facility level, IDEX components are essential for primary and standby power generation.
Yes, because the uptime requirements for an AI data center are absolute. If a facility loses grid power for even a fraction of a second, you don't just lose a few unsaved Word documents.
You interrupt millions of dollars of continuous AI training runs.
Right. So the data center has to instantly fail over to massive backup generators. And those industrial scale generators require highly specialized pneumatic controls to kick in with zero latency.
And that's just the macro level plumbing.
The truly revolutionary growth for IDEX is happening inside the server racks themselves. As you increase the compute density of a GPU, traditional air conditioning, using massive fans to blow cold air across the server blades, hits a wall of physics.
Air simply cannot absorb and move heat away fast enough to prevent an NVIDIA H100 or the new Blackwell chips from burning up.
Exactly. The entire AI hardware industry is being forced to transition to direct-to-chip liquid cooling.
Here is where it gets incredibly visceral. We are talking about literal water or specialized chemical coolants being pumped through microscopic cold plates directly on top of chips that cost $40,000 a piece.
It sounds crazy when you say it out loud.
It really does.
Yeah.
You are circulating pressurized liquid millimeters away from millions of dollars of hypersensitive electrified silicon. It is a terrifying engineering problem.
The stakes are incredibly high.
If a single valve leaks, if a manifold cracks, or if a pump stutters and the flow rate drops for even 10 seconds, you don't just get a blue screen of death, you physically destroy the hardware.
Which means you cannot go to the local hardware store and buy a cheap PVC pipe and a sump pump for this.
You absolutely cannot. The tolerance for failure is zero.
And this is why IDEX is capturing so much value. They're the masters of ultra-reliable, highly engineered fluidics and flow control.
So they are designing and manufacturing the specialized cold plates, the quick disconnect valves, the manifolds, and the precision pumps that allow these liquid cooling systems to function flawlessly under immense thermal stress.
That's exactly right. It reframes the entire company. You can think of IDEX as the central nervous system, or maybe the immune system, of the AI physical build-out.
While the retail investing crowd is fighting over allocating capital to the chip designers at sky-high valuation multiples, IDEX is quietly sitting in the background, monopolizing the physical plumbing that prevents those chips from self-destructing.
It is a brilliant backdoor way to play the AI supercycle without taking on the extreme valuation risk of a pure-play tech stock.
And that strategic positioning transitions perfectly into their second advantage market, which is also deeply tied to the AI supercycle.
You're talking about semiconductors.
Right, the actual fabrication of the chips themselves.
Fabricating a modern microchip is arguably the most complex manufacturing process human beings have ever devised. It operates on the nanoscale.
The environment required to etch billions of transistors onto a silicon wafer must be pristine beyond comprehension.
Completely pristine. A single speck of dust, a microscopic fluctuation in gas purity, or a slight change in temperature can ruin an entire batch of wafers,
Costing a fabrication plant millions of dollars in ruined yield.
and IDEX is deeply embedded in that extreme environment. Looking at the commentary from the CEO, Eric, IDEX is deploying serious material science expertise here.
They are engineering the high-purity gas filtration systems, the complex sealing solutions, the optical detection units, and the thermal management systems that actually go inside the photolithography process tools.
They're basically providing the invisible architecture of the fab.
But what is particularly illuminating about this quarter's transcript is the specific technology Eric highlighted regarding their thermal management division.
Oh yeah, he spent a notable amount of time discussing a new, environmentally friendly water heater they designed specifically for semiconductor fabs.
I flagged that too, because it felt like a very specific, nerdy engineering detail to bring up on an earnings call with Wall Street analysts.
It did seem a bit in the weeds at first glance.
But when you break down the mechanics of why he mentioned it, it reveals so much about their pricing power. So let's explain the mechanism here for the listener.
Please do.
In a traditional semiconductor fab, they require massive amounts of ultra-high purity water at incredibly precise, elevated temperatures to clean the wafers between chemical etching steps.
And historically, to ensure that hot water is instantly available the second a process tool needs it, a fab has to run massive industrial water heaters 24 hours a day, 7 days a week.
They have to leave the system idling at full temperature.
Which is an astronomical waste of energy, and more importantly, a massive waste of water.
Because that ultra-pure water is constantly circulating and degrading, so they have to constantly flush it and replace it.
Right. Semiconductor fabs are notorious for severely draining the municipal water supplies of the cities they operate in.
It is a massive environmental and operational bottleneck for companies like TSMC or Intel when they try to build new fabs in places like Arizona or Texas where water is already scarce.
And this is where IDEX's engineering solves a multi-million-dollar headache.
They engineered a specialized thermal solution that provides instantaneous, ultra-precise, high-purity water heating without the need to fully idle the system.
They effectively created an on-demand, high-volume thermal system that maintains the extreme purity requirements but saves massive amounts of water and electricity.
If you are building a $20 billion fab in a desert, an environmentally friendly heater that significantly reduces your municipal water draw isn't just a nice to have.
No, it is a critical regulatory necessity. It is the perfect encapsulation of the IDEX business formula, which management actually explicitly laid out on this call as a core philosophy.
They aim to provide maximum solutions impact as a profoundly small percentage of overall systems costs.
It's such a vital concept for investors to grasp. Maximum impact, small percentage of cost.
Let's translate that. If a company like ASML is building an extreme ultraviolet lithography machine that costs $200 million, and it requires an IDEX high-purity gas filter to operate, that filter might only cost $10,000 or $20,000.
On a $200 million bill of materials, the IDEX component is literally a rounding error.
It is mathematically insignificant to the buyer. But if that $10,000 filter fails, or lets a single microparticle through, the entire $200 million machine goes down.
And millions of dollars of silicon wafers are destroyed.
Exactly. That asymmetry creates ultimate pricing power.
Because the cost of the IDEX component is so infinitesimally small relative to the total system cost, the customer is completely price inelastic.
The procurement manager at a semiconductor fab is never going to haggle over a few $1,000s and risk buying a cheaper, inferior, unproven pump that could destroy their chip yield.
Never. They will happily pay whatever IDEX demands because the cost of failure is catastrophic.
And once you are designed into that multi-million-dollar machine, you stay there. Which brings up a massive milestone they announced in the HST segment.
Oh, this was huge. Management stated that 50% of their entire HST semiconductor portfolio is now recurring revenue.
That is a transformative metric. Industrial companies historically suffer from the lumpy nature of capital equipment sales.
You sell a big machine, you get a big influx of cash, and then you have to wait 10 years for the customer to need a new one.
But IDEX has fundamentally changed that dynamic, largely driven by their strategic acquisition of IDEX Corporation a few years ago.
Mott specializes in highly engineered filtration, and filtration naturally lends itself to a recurring revenue model.
Right, because by the laws of physics, a filter's job is to catch debris. Eventually, no matter how well engineered it is, it gets dirty, it gets clogged, and the pressure drop across the filter becomes too great.
It has to be replaced as a consumable.
So by locking in the initial design win on the core semiconductor process tool, IDEX secures an ongoing high-margin annuity stream of replacement filter sales for the entire multi-decade lifespan of that fab.
It creates incredible revenue visibility and margin stability, smoothing out the historical cyclicality of the semiconductor industry.
And this exact same dynamic locking into the foundational design specs is driving the third advantage market in the HST segment, space and defense.
Again, we are talking about a company that started out making basic fluid pumps, and now they are a critical player in the space economy.
What exactly is IDEX doing in low Earth orbit?
They are operating at the bleeding edge of aerospace material science. IDEX is providing highly custom, deeply engineered components for lower orbit communications networks and rocket payload filtration systems.
The CEO made a fascinating point on the call about the pace of collaborative innovation in this space.
He did. Because the commercial space industry is evolving so rapidly, there are no existing historical standards for many of these mechanical problems.
So IDEX engineers aren't just sitting in an office waiting for SpaceX or Blue Origin to send them a completed blueprint to bid on.
No, they are physically in the room with the rocket scientists, helping to write the foundational specifications for how fluid dynamics and gas filtration will function in zero gravity and extreme radiation environments.
They are defining the standard.
Exactly. And in the aerospace industry, the qualification process is brutally rigorous. It takes years of vibration testing, thermal vacuum testing, and radiation exposure to get a component space qualified.
But once your highly engineered proprietary valve or filter is written into the foundational spec of a lower orbit satellite constellation or a rocket propulsion system, you are permanently locked in.
The switching costs are astronomical. No aerospace engineer is ever going to swap out a space-qualified IDEX component for a cheaper competitor once the rocket is on the launch pad.
The risk to a $100 million payload is simply too high.
Far too high.
So across data centers, semiconductors, and space, IDEX is leveraging extreme engineering complexity to create permanent price inelastic moats.
That explains the 47% order growth in HST. It is a phenomenal narrative.
But we cannot ignore the rest of the business because IDEX operates two other major segments, FMT and FSDP. And frankly, while they didn't post 47% growth, they were still incredibly robust.
Let's look at FMT first, which stands for Fluid Metering and Technology. They saw 11% organic order growth.
An 11% order growth in FMT is actually a massive achievement when you contextualize it against the broader macro environment.
It really is. Some of IDEX's legacy end markets within the FMT segment, specifically agriculture, basic chemicals, and traditional energy extraction, were actually quite soft this quarter.
Farmers aren't buying as much equipment, and chemical plants are delaying upgrades.
Exactly. The 11% growth was heavily driven by a ruthless, targeted focus on two specific areas that are working: their intelligent water platform and their critical minerals mining business.
The intelligent water platform is a fascinating pivot. When a retail investor hears water utility infrastructure, they usually picture clean drinking water flowing out of a tap or massive desalination plants.
But IDEX explicitly stays out of the clean water market. As CEO Eric noted, they purposefully stay over on the messy part of things.
They are entirely focused on municipal wastewater management.
And that is where the most urgent municipal spending is happening right now. With their strategic acquisition of a company called EnviroSite, IDEX has positioned itself as the technological vanguard for aging municipal infrastructure.
We are not just talking about heavy iron pumps anymore. We are talking about advanced analytics, precision diagnostic software, and highly sophisticated robotic inspection cameras that operate deep underground in toxic sewer systems.
This solves a massive municipal headache. Across the developed world, wastewater infrastructure is crumbling.
Cities have clay pipes laid in the 1920s that are collapsing, or massive blockages forming deep underground.
And historically, when a city suspected a major leak or a structural failure, they had to blindly dig up entire city streets, disrupting traffic and commerce for weeks just to find the problem.
It was incredibly inefficient and expensive.
Now, instead of blind excavation, IDEX provides the high-tech robotic rovers that crawl through the sewer lines, utilizing advanced optical sensors and analytical software to map the structural integrity of the pipes in real time.
They can pinpoint the exact millimeter where a microfracture is occurring or where a root intrusion is blocking flow.
They act as the diagnostic tip of the spear for municipal capital allocation.
A city could deploy its limited repair budget with surgical precision. And the software aspect of this means IDEX is, once again, generating high-margin, recurring revenue through analytics subscriptions, not just selling metal hardware.
It's brilliant. And then shifting to the other growth driver in FMT, there's the mining side of the house.
Management stated they have dedicated a strict 80-20 focus to mining critical minerals. Now, I want to pause this specific company analysis for a second and really dive into this concept.
The 80-20 rule.
Yeah, because the executive team mentioned 80-20 repeatedly as the core operating philosophy of the entire corporation. For the uninitiated, what exactly is the 80-20 principle in the context of industrial manufacturing?
It is a concept that is widely misunderstood, but incredibly powerful when executed correctly. The 80-20 rule, formerly known as the Pareto principle, was developed over a century ago.
Right, it observes a fundamental imbalance in nature and economics.
Exactly. Roughly 80% of outcomes come from just 20% of the causes. In corporate strategy, particularly in legacy manufacturing, this manifests in a very specific, dangerous way.
How so?
Over decades, a company will accumulate thousands of product lines, thousands of customers, and operate in dozens of countries. But if you run a ruthless mathematical analysis on their profitability, you will almost always find that roughly 80% of their total profit is generated by just 20% of their highly engineered products, sold to a core 20% of their best customers.
Meaning the vast majority of what the company does every day, the other 80% of their catalog, the thousands of small demanding clients, the legacy product lines, is only generating 20% of the profit.
It is essentially dead weight.
It is like cleaning out your garage. You look around and realize you only actually use 20% of the tools on a regular basis. The other 80% is just taking up valuable space, gathering dust, requiring maintenance, and causing you unnecessary stress when you can't find what you actually need.
A perfect analogy. But most management teams lack the discipline to clean the garage.
They are terrified of losing top-line revenue, even if that revenue is highly unprofitable.
They want to be everything to everyone. IDEX uses the 80-20 philosophy as a surgical tool to effectively and ruthlessly allocate engineering resources and capital strictly toward their highest value opportunities.
If a product line or a customer isn't in that top 20% of profit generation, IDEX will either raise the price astronomically, simplify the product, or simply walk away from the business entirely.
And we see the exact application of this in their mining division. They acquired a company called Able Pumps.
Historically, a pump manufacturer would try to sell to every single mine on Earth. Coal, iron, gold, whatever.
But IDEX applied the 80-20 framework. They looked at the macro landscape and realized the real margin and the real future growth wasn't in general thermal core mining.
It was exclusively in the mining of critical minerals. We were talking about lithium, copper, cobalt, the foundational minerals powering the electric vehicle revolution, battery storage, and the green energy transition.
So, utilizing 80-20 discipline, they told that business unit to drop the distractions. They stopped spending R&D on low-margin general mining applications.
They bet the entire franchise on critical minerals.
They mapped out the global landscape of critical mineral extraction and dedicated 100% of their engineering time to solving complex slurry and dewatering problems for those specific high-value customers.
And it is working flawlessly. Management noted that the Able business has grown every single year since they acquired it.
By actively shifting resources away from low-margin legacy distractions and betting the house on highly concentrated, custom-engineered components for critical markets, they accelerate growth while simultaneously expanding their profit margins.
And this exact same ruthless discipline was evident in the third and final segment, FSDP, which stands for Fire and Safety and Diversified Products. They posted 19% order growth in this segment.
A very strong print, which was bolstered by two highly specific drivers that demonstrate their dominance in niche markets. First, they secured a massive, significant blanket order in their aerospace business at a subsidiary called Band IT.
Now, Band IT is fascinating. They make high-performance fastening solutions.
Basically, highly engineered, indestructible metal bands and clamps that hold critical components together under extreme stress.
And they secured a blanket order in aerospace. In the manufacturing world, a blanket order is the absolute holy grail.
It really is. You don't have to fight for individual sales every quarter.
The customer, likely a massive aerospace prime contractor, has tested your component, verified it is indestructible, and basically says, we will buy every single fastener you can produce for this specific aircraft program over the next 5 years.
It provides incredible revenue visibility. It allows IDEX to optimize their factory floor, purchase raw materials in bulk with perfect foresight, and guarantee a baseline of high-margin revenue.
And the second driver in the FSCP segment was continued momentum in their North American fire and rescue demand. They are the premier provider of the pumps and valves that go onto municipal fire trucks.
They currently have a massive multi-year backlog in these mobile fire platforms.
And they aren't just resting on their laurels with basic fire pumps. They are continuously integrating higher margin, automated technological gear into those legacy platforms.
Modern fire trucks are becoming incredibly sophisticated, requiring complex electronic flow controls to manage water pressure dynamically, and IDEX owns that market.
So when we step back and look across the board, HST at 47%, FMT at 11%, FSDP at 19%, we are seeing aggressive double-digit organic order growth across the entire enterprise.
Which brings up a fascinating operational tension.
Right. If the 80-20 strategy is driving all these massive current orders, how on earth is management preparing for the long-term delivery of this massive backlog? You can't just wish manufacturing capacity into existence.
And that operational reality necessitates a deep dive into management guidance. When a manufacturing company sees this level of structural demand building in their backlog, they are forced to update their forward outlook, and IDEX did not hold back.
They signaled immense confidence in the durability of this demand cycle.
They effectively raised the roof on their 2026 projections. Let's run through the updated numbers to see exactly how bullish they are.
Management raised their full-year organic growth targets from a somewhat modest 3% to 4%, all the way up to a robust 5% to 6% range.
They bumped their adjusted EBITDA margin expectations up to 27% to 27.3%.
And crucially, they raised their adjusted EPS guidance for the full year to a range of $8.70 to $8.85.
Which represents high single to low double-digit earnings growth year over year.
In an industrial market where many analysts and macroeconomists are forecasting stagnation or even a mild recession, IDEX is significantly accelerating.
But if we connect this financial guidance to the physical reality of their factories, there's one specific metric in their guidance update that is perhaps the most actionable piece of data for an investor trying to understand the long-term thesis here.
What's that?
Management boldly raised their capital expenditures, or CapEx, from $90 million to $110 million.
Okay, I have to jump in here because this requires serious translation for anyone who isn't a seasoned industrial investor.
Fair enough.
Normally, when a manufacturing company gets on a quarterly earnings call and announces, hey everyone, we are going to spend an extra $20 million on new infrastructure, new machines, and factory capacity, Wall Street violently panics.
They do. Analysts instantly start worrying about profit margins deteriorating.
They worry about the return on invested capital dropping. The immediate fear is that management is building bridges to nowhere, spending shareholder cash to build factories for demand that might evaporate by the time the factory is actually built.
It's a classic cyclical trap.
Exactly. So why is IDEX's management almost bragging about this CapEx increase? And more importantly, why isn't the market severely punishing the stock for spending more money?
It all comes down to the fundamentally changing nature of IDEX's backlog and the unprecedented visibility they now have into the future.
Historically, as the CEO Eric explained in great detail, IDEX was what you would call a rapid replenishment, short-cycle business. They lived quarter to quarter.
An order would come in from an industrial distributor on a Tuesday, and IDEX would manufacture and fulfill it almost immediately, often within days or weeks.
They rarely had true visibility beyond the next 90 days.
Right, the classic up and down the street industrial distribution business. You stock the shelves, you sell the product, you restock the shelves.
Exactly. And in that historical short-cycle model, if a company suddenly ramps up CapEx, it is incredibly dangerous.
Because they have no long-term visibility, building a new factory is purely speculative. They are guessing that the economy will still be strong 2 years from now.
But IDEX's reality has fundamentally changed because of their aggressive strategic pivot into AI, data centers, semiconductors, and space.
These clients operate on multi-year, multi-billion-dollar build cycles. And right now, these clients are so desperate for future capacity, they are terrified of supply chain bottlenecks in 2027 and 2028.
So they aren't waiting to order. A major semiconductor fab or a hyperscaler building an AI data center isn't calling IDEX a month before they need the parts.
No, they're calling IDEX today and saying, we are breaking ground on a $5 billion facility. We need to legally lock in your pneumatic controls, your liquid cooling manifolds, and your high purity filters for the data center we are turning online 2 years from now.
Precisely. They are pre-booking massive, non-cancelable orders deep into 2027 and 2028.
The CEO explicitly stated on the call that at the midpoint of this year, they have twice the business set up for the following year than they had at this exact same time last year.
Let that sink in.
Yeah.
Their forward visibility has doubled.
So, when management announces they are spending an additional $20 million in CapEx, it is not speculative in the slightest.
It is practically guaranteed locked-in revenue. They're expanding physical capacity exclusively to fulfill long lead time orders from some of the most well-funded technology and defense behemoths on the planet.
It is entirely de-risk spending. They basically already have the multi-million-dollar purchase orders in hand. They just need to build the physical factory lines to execute the manufacturing and cash the checks.
That represents a massive structural shift in their business model.
It transitions them from a cyclical industrial player constantly at the mercy of short-term GDP fluctuations into a long-cycle structural growth engine.
It gives them a revenue floor and a degree of forward predictability that most industrial companies would kill for.
And importantly, from a balance sheet perspective, even with this $20 million increase, IDEX remains a highly asset-light business relative to their peers.
Spending $110 million annually on CapEx while simultaneously generating the immense free cash flow that they do is incredibly manageable and highly accretive to long-term shareholder value.
Which brings us perfectly to synthesizing all of this into actionable takeaways.
We've thrown a massive amount of technical data, thermodynamic theory, and accounting mechanics at you today, but it is time to land the plane and figure out what this actually means.
So, if you are an investor sitting there looking at your portfolio, trying to figure out how to allocate capital in a market that feels increasingly bifurcated between overvalued tech and stagnant industrials, how should you view IDEX Corp?
I will take a firm, highly opinionated stance on this. The data from this quarter signals a profoundly strong, bullish setup for the long term.
I agree. IDEX has successfully and very quietly de-risk its portfolio from the traditional cyclical industrial swings that plague the sector.
By ruthlessly applying that 80-20 strategy, they have tethered their growth engine to the most powerful, unstoppable, secular megatrends of our era.
The exponential scale-up of artificial intelligence infrastructure, the commercialization of space exploration, and the geopolitical drive for semiconductor sovereignty.
They are no longer just a proxy for whether the global economy expands by 2% next year. They are a direct, physical proxy for the build-out of the next generation of human infrastructure.
And what makes it such a uniquely compelling setup for a retail investor is the capital allocation safety net sitting underneath all of this tech-like growth.
That is the crucial differentiator. Because despite posting explosive 47% order growth in their HST segment that looks like a Silicon Valley software company, IDEX still offers the profound financial safety, prudence, and balance sheet discipline of a century-old industrial compounder.
If you look at their leverage metrics, they decreased their gross leverage down to a very comfortable 1.9 times.
They're sitting on over $1.1 billion for total available liquidity.
They are absolutely flush with cash, and they are not hoarding it, nor are they blowing it on reckless, unproven acquisitions.
They are aggressively returning that capital directly to shareholders. Management committed to executing $75 million in share repurchases every single quarter for the remainder of 2026.
And that is on top of paying their regular growing dividend.
That kind of programmatic, consistent share buyback program provides a tremendous floor for the stock price.
It signals to the market that management, who has the best visibility into that massive order backlog, believes their own shares are structurally undervalued.
It protects investors from severe downside volatility. You essentially get the explosive upside exposure of the AI and semiconductor supercycles, but with the downside protection of an industrial fortress balance sheet.
It is a rare combination of growth and value.
It really is the best of both worlds. And that brings us to a final provocative thought for you to mull over as we wrap up this deep dive.
The entire narrative we just discussed hinges on the physical infrastructure required for the digital age. But if you connect IDEX's aggressive pivot into critical minerals, space defense, and domestic semiconductor fabrication, they aren't just an industrial infrastructure proxy anymore.
They are quietly becoming a direct proxy for U.S. geopolitical onshoring.
That is a fascinating vector to consider. For the last 30 years, the global economy was built on hyper-efficient, highly fragile, globalized supply chains.
But we are currently witnessing a massive geopolitical fracturing. Nations are realizing that relying on foreign adversaries for critical minerals or relying on vulnerable offshore facilities for advanced microchips is a profound national security risk.
Exactly. The U.S. government is pouring hundreds of billions of dollars into reshoring semiconductor fabs to places like Arizona and Ohio through the CHIPS Act.
They are frantically trying to secure domestic supply chains for lithium and copper. And who is providing the hypercritical, non-substitutable fluidics, pumps, and thermal management systems that allow those domestic fabs and mines to physically operate?
IDEX.
So the question you have to ask yourself as an investor over the next decade is this: if deglobalization continues to accelerate and the reshoring of physical infrastructure becomes the ultimate national security imperative, how much of a premium will the stock market place on the companies that physically hold the domestic supply chain together?
It forces a complete reevaluation of what constitutes a strategic investment moat in the modern era.
The intellectual property of a chip design is vital, but the ability to physically manufacture it within your own borders is the ultimate geopolitical leverage.
Companies like IDEX are the indispensable foundation of that capability.
They are the ultimate stealth beneficiaries of a deglobalizing world. Thank you so much for joining us on this deep dive into IDEX Corp.
We hope we helped you cut through the noise, understand the mechanics beneath the financials, and find the real signal in the data.
Keep digging into the supply chains, keep questioning the consensus narratives, and we will see you on the next one.